Welcome to the most dynamic show in mortgage, banking, and real estate sales. In this business, you need to get things done and dominate. You need energy. Get ready for your dose of Big Skip energy. Wendy, welcome to the Big Skip Energy Podcast. How you doing?
I'm doing great. A little chilly, even though I'm in Florida. How you doing, Skip?
Oh, I'm doing good. Listen, 50 is not chilly. I woke up this morning at 16. All right.
Hey, it's all relative. It's
Yeah,
chilly
that is
here.
true. As with most things in life, it is all relative. So, and as I'm about to take a sip of this coffee, as you can see, I've got my trusty RHMI mug here. I haven't gotten a kind lending one from you.
We're going to have to hook you up.
We will. I tell you what, we will have a merch exchange. I will send you podcast merch in exchange for kind merch.
I love it. And I'll even send you kind merch even without podcasts. That's how much I'm a giver, Skip. That's how much I like.
Beautiful.
Yes.
Wendy, do me a favor. For listeners that may not know you, be familiar with you, that kind of thing, just take a minute and introduce yourself for me, please.
Sure. So my name is Wendy Licis, and I have been in the mortgage lending space for, oh my gosh, 35 years now. I'm aging myself.
My goodness, I was 9 years old.
Oh, come on now. Now, in my defense, it was my first job out of college at age 20, and I am one of the crazy ones that never got out. So I have never done anything else. I started on the retail side, spent about 10, 12 years on the retail side, flipped over to wholesale. I rode out the 2007 and 8 meltdown.
Right.
Fortunately, I was at large banks, so I wasn't impacted. And here I am today.
Here you fast forward, and here you are today.
Fast forward, yes.
Yeah, you are a mortgage lifer just like me. I started out in secondary when I got out of college and have been in this for the better part of whatever that is now, 20 plus years. So yeah. Well, we're in it for the long haul, aren't we?
Yes, we are.
So fast forward now, and you are with Kind Lending in the non-QM space. So
yes,
let's take a minute for the folks out there, out there that may not be in the mortgage business or maybe on the outskirts or an ancillary industry, something like real estate, whatever. Take a second, define what non-QM really means, because for those that don't know, this will be important, but also for those that may be a little familiar with it, they may have a misconception about what it is. So please fix that and define it for me.
I am so glad you asked, because yes, I do think there is a lot of misconception out there as to what a non-QM loan is, what that borrower looks like. It may surprise you to know that the average credit score on a non-QM loan is 740. So they're not credit criminals. This isn't the subprime days.
Yeah. Well, that's what a lot of people misconstrue it for.
Yes.
That's not what it's designed to do.
Nope, not at all. And so, these are well-qualified borrowers that have good credit and money in the bank, but for whatever reason, they just don't fit that agency credit box. Frequently it's because they're writing everything off on their tax returns. It's kind of, in some ways, the old Sissa Nina borrowers. Remember that from back in the day when you have a self-employed borrower that wrote everything off, but if they had good credit and money in the bank, you would get the stated findings. That's today's non-QM borrower.
Yeah.
And so we have some really creative, flexible products out there to help these borrowers accomplish their mortgage goals.
Yeah. So I think that, again, going back to a lot of people misconstrue it for the new subprime, and that's not the case. And a lot of cases, what gets defined as a qualified mortgage, at least in my opinion, can be riskier than what a non-QM loan is. Because just because it meets the definition for the ability to repay and meets the requirements of Appendix Q, all this kind of thing, doesn't necessarily make it a more sound loan, in my opinion.
No, I agree with you 100%.
Yeah.
Non-QM loans typically require a little more down payment, right? They in many situations require reserves. So again, I go back to these are well qualified borrowers who just don't fit that agency box for many different reasons. One of
Mhm.
them being writing everything off. Another one, the investors who own multiple properties, right? That aren't eligible for Fannie Freddie investment property financing anymore.
Mhm.
That's another great demographic that fits really well into the non-QM loans. So really they are loans that tell a story. I like to say every non-QM loan tells a story. And so it's up to us to make that story make sense
Mhm.
by documenting this borrower's credit worthiness, right?
Yeah, exactly. Credit worthiness is a broad term and can mean different things. And I'm glad that you brought the demographics and that kind of thing of it. Talk to me a little bit about who some of the most frequently served professions and types of borrowers are that non-QM kind of services.
Sure. Well, as I said, it kind of runs the spectrum. We see
Hmm.
everything. We see a lot of professionals, lawyers, doctors. Maybe they've recently switched income qualifying types. Maybe they've recently been W 2'd. Now all of a sudden they're 1099. These are professional borrowers,
Hmm.
right? So it is someone who just doesn't fit that agency box. And a lot of business owners are writing everything off on their tax returns,
Hmm.
right? And then we look at other options like our 1099 borrower, for example. Guess who the first 1099 borrowers were that we saw? Very first ones jumping to the front of the line with their hands up.
Why don't you tell me?
Realtors.
Realtors. Oh gosh.
Realtors, yes. Because when you think about it, they write everything off.
Yeah.
They're writing off open houses, they're writing off marketing expenses, they're writing off the gifts that they're giving to their borrowers at the closing table. And a 1099 loan is so easy because you're qualifying solely based on the 1099s and you just apply a flat 10% expense factor and that's it. We never even look at the tax returns.
Yes.
Same with the bank statement loans,
Ironic, isn't
right?
it? Yeah, yeah, yeah. Well, speaking of bank statements, what are some of the most common types of non-QM loans that people are going to see out there? I think a lot of people that maybe a little bit familiar with non-QM know about the bank statement, that kind of thing, but that and or
Sure.
1099, for example. But what are some of the more common products you see out there, just across the board in the non-QM space?
Absolutely. Well, let's start at the beginning and kind of go through each and what those borrowers look like. So, if I start with bank statement loans, for those who are not familiar with a bank statement loan, where have you been? No, I'm just kidding. These are the self employed borrowers that are writing everything off on their tax returns. So, we are qualifying these borrowers solely based on the deposits going into their bank account.
Hmm.
That is how we are qualifying them. And they can be a business owner that has no employees, like a therapist or an accountant or an attorney or a lobbyist. They can be a business owner that has multiple employees. It can be a restaurant, it can be a car wash, it can be almost anything. We
Hmm.
see a lot of these self employed borrowers because by nature, they write off everything they possibly can, right? So they're the perfect fit for the bank statement loans. The 1099 loans are another really popular option with self employed borrowers. And these are really easy because it's a flat 10% expense factor, and we're just going to add up all their 1099s. They can have one or they can have 20, it doesn't matter, and deduct 10%, and that's your qualifying income. It is so easy. And we see a lot of Uber and Lyft drivers
Yeah.
in this category, right? We see also truck drivers.
Hmm.
We see, as I mentioned, realtors. We also see occupations you may not even think about, like plumbers, for example. A
Sure.
lot of plumbers belong to pipe fitter unions. They
Hmm.
pay by 1099. So they may have 20 different 1099s from all these different jobs. So really, it's anybody that's receiving 1099 income that is writing things off on their tax returns. There's
Yes.
a lot of different options for loans that can't fit that agency credit box. We also have a P&L only option
Mm.
where if you have a licensed CPA preparing a P&L, we'll go by the income and expenses directly from the P&L statement.
Yeah.
So there's a lot of different options And, I think that's what loan officers and people like myself are out here for, is to help put those loans together to make sure that borrower is in the best possible program for their situation, make it as simple and easy as possible, less documentation. And one of the other bigger buckets of non-QM that we see is the DSCR loans,
Yep.
right? Debt service coverage ratio, which is really just a fancy way to say cash flow,
Yeah.
right? You're qualifying based on the cash flow of the subject property. So there's no income, there's no employment on the 1003, nothing. It is treated as a business purpose loan. So there's no TRID timelines. So they
Hmm.
move through the pipeline really quickly, closing fast. There's no intent to proceed needed to order the appraisal.
Yeah.
There's no
Full
7,
commercial deal.
3, yep, no 3, 7, 10-day wait periods, none of that. And it's especially good for people who have multiple investment properties because there's no limit on the number of properties the borrower owns or has financed.
As
It's
opposed to
unlimited.
most agency lenders do put a limit on it in case anyone was going, was wondering where she was going with that.
Absolutely.
Yeah.
So, it's and because there's so little documentation, right?
Right. Well, it's focused on that specific property. So,
Correct.
yeah.
We're qualifying based on the cash flow of the subject property.
So
So it's just very fast and easy.
I think I think it's important to realize that, you know, hi historically, a lot of the borrowers that could take advantage of these non-QM products have gone to credit unions, community banks, and I think there's still a huge need for that. But also, I think,
Sure.
and please correct me if you think I'm wrong here, but I think banks, credit unions could also serve their customer bases better if they partnered with somebody like Kind, for example, for when, you know, their balance sheet doesn't have the appetite for that 1 to 4 family anymore, but they still have a high concentration of self-employed or contract borrowers to have. And plus, they also a lot of times don't offer, most times actually, that 30-year option, right? It's
Sure.
usually a balloon or an arm. This is a good way to get into a 30-year fixed rate loan, which in the predictability of cash flow is a big deal. Would you agree with that?
100%. It's
Yeah.
a great partnership,
Yeah.
right? Because they're still serving their customer
Hmm.
and we don't want, we're not looking for deposit relationships with anybody,
Right.
right? So, it's kind of a win for both of us. They get to still help serve their customers' needs. We're able to help their customer get into a non-traditional financing loan, meaning non-traditional income qualifying types. And we do a lot of loans for banks and credit unions just for
Mhm.
that reason.
Yeah, it seems like a natural fit. So, what do you think? I guess name the top 2 or 3 reasons why non-QM has not been as well received in recent years as, frankly, it should be.
Sure. Well, I don't think they're good reasons, but I'll give you reasons.
Sorry, yeah, exactly. Yeah, I guess that was a loaded question. Main reasons. How about not good reasons?
Yeah, yes. So I think, one of the reasons is there is still some of those misconceptions out there,
Hmm.
right? I think
Hmm.
that some people do have a negative connotation when it comes to non-QM because they do confuse it with subprime, and it is nothing whatsoever like subprime in any way. And I think also until fairly recently, there was a lot of agency business to be done.
Hmm.
Remember during and after COVID,
Right.
everybody, we went through a refinance cycle.
Hmm.
So loan officers had more loans than they knew what to do with. And
Right.
so they weren't as likely to take the time to learn about new products and how to leverage those products to
That was a
enable them
much
to.
nicer way of saying the reason I was going to give is that they're lazy. So they don't.
No, no, Skip, they're not
No, no, I
lazy.
can say that. You can't say
They're
that.
very busy. They're just very
They're very
busy.
busy. Yes,
They're very
lots of
busy.
demands on their
Yes.
time. But no, I
Yes.
mean, all joking aside, learning something new is hard to do. It takes time, and they're gonna,
Sure.
just like everybody else, they're going to take the path of least resistance, right? So I think they've missed
Absolutely.
opportunities in the recent years. Now, I'm sorry, I didn't mean to interrupt you. What are some other reasons that you come across?
Those are, I think, the two
Mainly?
biggest ones that I come across. And I think once you start having that conversation, once I explain, hey, listen, it's really simple. It's not what you think it is. And I think once they realize that there is a huge opportunity out there
Mhm.
because these are growing demographics. Let me just give you an example. In March of 2023, as an example, right? Or 2024. Let's use 2024, more recent. There were over 450,000 new business applications in 1 month. Extrapolate that out over 12 months.
Yep.
So the self-employed borrower demographic is growing exponentially.
Okay.
And right now, the gig economy, partly, I think, due to COVID, the gig economy is actually the fastest growing segment in the
Yep.
US economy today.
Yep.
So these products are a perfect fit for those types of borrowers. We have options. Here's another example for a perfect non-QM fit. Someone who maybe started their company 12 months ago
Mhm.
and they don't have a 2-year history of being self-employed.
Mhm.
Non-QM has a home for that borrower.
Yeah.
So it's any borrower that doesn't fit that agency box, it's always a conversation.
Yeah.
It's kind of one of those things. If you look at a loan or you look at a borrower and you say, you know what, I would write a check for that, right?
Yeah.
It makes sense.
Right.
The loan makes sense. It's a good borrower. They've got, 760 credit. They've got a couple 100,000 in the bank, but they just don't fit that tight credit box.
Mhm. Well, that's the
That
thing, and
that's
it's
a
like,
non borrower.
yeah, you're not gonna tell me that a 96.5% FHA loan with a 640 score, not picking on these folks now, I'm just saying
Sure.
that and a 48% DTI is a less risky loan than a 70%, you know,
Uh,
non-QM loan with 6 months
yeah.
reserves. And a 7,
Sure.
like,
Well,
you're just not gonna convince me of that.
well, because it's not accurate, right?
Yeah.
And then
I
you
mean,
think
look at
about,
the, delinquency rates. You know what those
right?
I do. So how does that
Yeah.
look in comparison?
The delinquency rate on the non-QM side is significantly lower than you would ever imagine.
Yeah.
And I think part of it is, going back to my example of that self-employed borrower who writes everything off.
Mhm.
He's probably had his company for several years,
Mm.
right? He is just taking advantage of every tax benefit he possibly can.
Sure.
So he has the ability to repay, the willingness to repay, right? They really are very well qualified borrowers and the loans perform well.
Yeah.
And to your point, someone who's got no skin in the game, right, is going to be a much bigger risk.
Yeah. Yeah. It's kind of a no-brainer to me. It's just, I think we as an industry need to do a better job opening up this knowledge base to the public. And
Sure.
I'm gonna kind of put you on the spot here a little bit, and ask you, what do you think needs to happen for us as an industry to get the word out more so that some of the taboo and some of the misconception and so on can get removed, and we can encourage more home ownership by essentially letting these borrowers know, hey, look, you don't have to go the traditional route. We have something good for you. Now, yet rate maybe a little higher. Yeah, it's fine.
Sure.
But
But let me touch on that for a second because the rates are in the sevens.
mhm, yeah,
So this is not a non, this is not a subprime rate.
yeah, you're not jumping
It
from a
is not hard
6% to a
money.
30-year to 10%.
Right.
Yeah.
You're really within a point and a half, depending on the program, of agency.
Yeah.
And so, and there's no MI
Mhm.
on any non-QM loans either. So if you're going above 80%, you don't have the added cost of MI.
Right.
So there are a lot of nuances to non-QM loans that I think people would find very surprising,
Mhm.
like that interest rate. And, it's not putting me on the spot per se, but, I think it's all about education
Right. Yeah.
because the more I get out there, the more I have the conversations like you and I are having right now,
Mhm.
people understand it. I think it's just like anything else. People tend to have preconceived ideas, right?
Yep.
And until you educate them on what it actually is, they don't know any different.
Mhm.
And so I've been really focused on getting out there, getting the message out, making sure that everybody understands here's how we can help these borrowers get the financing they need to get their dream home,
Well,
because
that's
these are
yeah.
well deserving credit qualified borrowers.
Yeah. Yeah, that's the thing, and I kinda liken it to the traditional kind of misconception of thinking that you have to have 20% down to buy a home, right? That
Yeah,
forever and ever,
forever.
lots of people
Yeah,
thought that that was the case, and we as professionals knew otherwise, and hell, that's still a thing that comes up today.
yeah,
You know, and so that, you know, I kinda liken it to that, and that we have to be sure that we communicate this effectively. But I think the key though is that it starts with the LO being educated as well. Because
absolutely.
I don't have any figures for this. I hesitate to even venture a guess, but I'm going to say at least half of the whatever 95,000 licensed MLOs that are still out there for 2025 do not have anything more than a very base level understanding of non-QM. You think that's fair or no?
I think it's very fair and 100% accurate as well, because I talk to these LOs every day, right? That's part of my grassroots effort to get the word out and to provide that education so that they understand how to structure these transactions.
Yeah.
We have non-QM loans, for instance, that will help a borrower who has overtime, commission, bonus income with no history of it.
Hmm.
We can use a non-QM loan to use that income to qualify them.
Yep.
So the one thing that I always say to loan officers is don't ever let a loan leave your desk without picking up the phone and having a conversation with your account executive,
Mhm.
and let us help you understand how you can structure this transaction,
Yeah.
because it's all about being creative, right? And telling the story.
Oh, yeah,
That's what
you gotta tell
non-QM
the
lending
story,
is.
and just because it doesn't fit the square peg or the round peg doesn't mean there's not a one that it can fit into.
Exactly. I
Very,
love it.
very
I'm going to
important.
steal that. Can I steal that?
Go for it. Go for it.
Okay.
Um, but yeah, I think that we as an industry need to do a better job of getting some of these because non-QM is not a fringe product. It's not like some random
No.
TPA out there. It's not this is something that's not going anywhere. It's got a good track record. It's got investor appetite. Y- You know, I think it's only going to start growing. And by the way, side note, do you happen to know the percentage of growth that non-QM's had over the last few years? I meant to look it up before we started recording, but do you happen to know roughly what that is? I'm
It
not gonna hold you to it.
is, see, now you are putting me on the
No, no.
spot.
Yeah, it's quite the exact percentage without
And
getting
I and I
technical.
I let me put it this way, I do know for a fact it is the largest growing
Mhm.
segment of the mortgage industry today.
Oh, yeah.
It is growing, it was about 10% of the overall production last year. They're estimating it to grow to 15% of overall production this year, maybe even to 20,
Mhm.
depending on the rates.
Yep.
Meaning, if the agency rates come down and it creates another refinance cycle, it might slow down the non-QM growth, but it is growing exponentially and faster than any other segment of the
Yeah.
market. So it is a very, as you said, the investor appetite is out there. And in fact, interestingly enough, frequently our non-QM pricing on, let's just say, a $2 million loan amount is actually better than a vanilla agency jumbo, because there's more liquidity right now in the market for the non-QM paper.
That's
The
right.
investors have more of an appetite for that than the jumbo investors have.
Can't go wrong with that.
Cannot.
Good stuff.
So we're excited to see it continue to grow.
Mhm.
From the DSCR side,
Yeah.
there were over 20 million rental units last year by individual investors like your mom and pops. That doesn't even count for corporations that are buying homes, in certain areas and renting them out. Over 20 million rental units earning income from mom and pop renters.
Yeah.
That's huge.
Yeah, I
And
read I can't remember where I heard this. It may have been at the Atlanta NBA meeting. I can't remember, but that there are a couple of markets that have a dearth of multifamily, and multifamily can fall under DSCR in some instances.
yes, yes, it can.
Yeah, and so,
Absolutely.
if you're wanting to get in on that game, there are options for you out there.
And there's also, when it comes to loan officers, one of the great things about the non-QM loans, once they understand them, there are a lot of different non-traditional referral sources that they can tap into
Yeah, yeah, yeah.
that they haven't considered, right? There's real estate investment organizations. There's a
Mhm.
big one, RIA,
Yep.
that, is a national organization with chapters all across the country. And they have meetings just like the mortgage bankers and brokers. And, the people that are attending those meetings are commercial or residential investors,
Mhm.
so there's just all kinds of avenues that open up from a loan officer perspective, additional ways to add people to their referral network. And as you probably know, there's an algebraic equation out there for referrals. And when you add just even a couple of people to your network, it exponentially grows the number of referrals you get
Yeah, the
back in
marginal
because
rate of return is very high on that.
yeah,
So,
absolutely. So, there's a lot of ways to target those two demographics
mm,
using non-traditional referral sources that, typically brokers and loan officers don't immediately think of, which is also nice because that means not everybody is going after them either, right?
absolutely. Hey, and everybody likes being the shiny object in town, right? So,
Yeah.
yeah, there is a tremendous upside to it. So, Wendy, if since we're drawing kind of to a close here, I want to be sure that you have an opportunity though to kind of speak to the LO audience out there and say, hey, look, be sure that you're doing A, B, or C as far as non-QM goes to take full advantage of the opportunities that are out there. You've already talked about, going out there, you have new referral sources, you've got specific, demographics that you can reach out to. But what's one more untapped thing that you think that LOs would benefit from knowing about?
I think just the non-traditional referral sources, I know I touched on it, but
Mhm.
just really thinking about how you're approaching your business on a daily basis,
Yeah.
right? And I'll give you some examples. I always like to use a dry cleaner because I think everywhere I've ever lived, there's a dry cleaner named Prestige Dry Cleaners in a strip center. And it's a family owned business typically. A lot of
Mhm.
these, almost every single one I go into is family owned. So, next time you go into the dry cleaner, say, hey, you know what? You've been doing a great job. Here's my card. I specialize in loans for self-employed borrowers and business owners. And I have ways to qualify you without using your tax returns.
Mhm.
Think outside the box, everything that you do in your day, until you kind of refocus yourself. If you go to farmers markets, I know I love farmers markets, right? Every single booth at that farmers market is a small business owner.
Yeah.
So, just kind of thinking about things a little bit differently is going to help a loan officer grow their referral base. When you think about, the National Home Builders Association, right? Typically, builders are partnered with banks, but they still need a resource for those borrowers that don't fit that agency box.
Mhm.
So I think, one of the biggest opportunities with non-QM is enabling loan officers to really rethink their referral sources and get creative
Yeah.
and think about things they may not have thought of, things like alumni associations, right? People like doing business with people, right?
Always.
And especially people that they feel a connection with,
Yeah.
that they have something in common with.
Yeah,
I
I think
spent,
it's isn't it funny though how we're talking about someone that's relatively I don't want to say new, but newer to our mortgage space, but the best way to take advantage of it is by doing some of the more traditional time
yeah,
tested skills that every LO should be doing anyway.
yeah.
Isn't
And
it?
I think it's also just reminding ourselves, right? I know I'm guilty of that sometimes.
Oh,
You
sure. We
know,
all
it's
get tunnel
you
vision
kind of
stuff.
have to refocus yourself and kind of think about, okay, what can I do different?
Yeah.
Right? What else can I do to try to grow my referral network? And that's what it's all about. If you do that as part of your daily activities, it will grow your referrals without you even trying.
Yeah. To be a trusted advisor, you got to have two
Yep.
things: trust and advice.
Absolutely.
And the more people that
Yes.
you can reach to give that advice to, the better off they'll be and the more robust your pipeline's going to be.
Absolutely. I couldn't have said it better myself.
No, yeah, it happens. So, Wendy, if anybody wants to get in touch with you, learn more about you, what should they do? Where should they go?
Well, I would love to hear from any loan officers, and you can reach me at Wendy at kindlending.com. And we recently really doubled down on our non-QM commitment. All of our non-QM products are our products. So there are guidelines, so we can do exceptions on everything. We're essentially the end investor. And I am happy to be a trusted resource for anybody out there that is looking for some help.
Awesome. I love it. Well, Wendy, thank you so much for coming on, sharing some non QM knowledge with everybody. And I really enjoyed having you.
Thank you, Skip. I enjoyed myself as well.
All right. See you soon.
Take care.